everyone. Hope you're all doing good. So, in today's session, we'll be covering MTP Series 2 November 2024 attempt. Okay, one great news for you. So, what is that, sir? Sir, other than MCQ questions, now we know that 30 marks is MCQ, either 70 marks is descriptive. Only the MCQ questions, you could say, are newly added, or a new type of question has been added in this MTP. The rest, all the descriptive, 70 marks ka descriptive paper, it's everything from our class notes, meaning from either from ICI material or past RTP, MTP they've taken and made this particular MTP ka descriptive paper. I'll just give you a quick reference before we start with that. Say, this is all your descriptive. I've called out the question number also. So now in this particular session, we'll be covering only those questions which are different. 1 minute. Yeah, those only which are little different, or there is any new adjustment to be learned. Only that questions will be covering over here. Those things which I've already done in a regular class, what's the point in doing the same thing again and again, right? So I've given the reference over here, like here. Question number 1 of descriptive is question number 90 in our class notes, Ind AS 110 CFS ka. So I've given, for each question, I've given a referencing like this. Like question number 2A is question number 98 in our class notes. So 2B is question 26 in our class notes. Like this, I've given a referencing. I'll just quickly show you this. Okay, so this is Ind AS 21, Ind AS 16 ka question 20 in our class notes. And when I say this question numbering, it is the regular notes ka numbering I've given, not the fast track notes. Okay, all these questions you'll find in fast track also, but referencing here is done on for regular questions. Okay, so all this. So if you just check entire questions, sir, all the descriptive question, not a single descriptive question is new. Everything is repetitive, either from our ICI material or RTP MTP question. So the only new outcome of this particular MTP is going to be the MCQ question. In fact, MCQ question also nothing new. Everything is from the concept we have learnt only. Okay, but quickly MCQ questions I will cover in this particular session. So it's mostly going to be a MCQ driven MTP wala session this is. Okay, so without delay, let's get started. Case scenario number 1. So they've given story. This is a global company and all that. Let it be global company. It's fine. We don't have time for all that. So year is ending on 31st March. That is the main component. Then we'll get to the case study. So now, normally, as I have told you, so before you dive into reading the case study, this case studies are pretty straightforward. They've given only one para, so it's not too much. Usually in the examination, the case study will be a little lengthier. So it's always a better approach first to read the MCQ questions quickly, saying to get an idea as to what is the requirement of the question. Okay, keeping the requirement in the question in mind, if you read the MCQ questions, you will understand it better, or you will focus on those things better, because in question they will give a lot of data. Some of the data will not even be required to solve MCQ question. So hence it's always a good practice to read the question first. So they're asking about third quarter ka what is the treatment of bad debts. So there's an interim financial statement in Ind AS 34 ka question. So some bad debts related question they're asking. Correct net profit they're asking. How many performance obligation they're asking. So you're relating to Ind AS 115. Then they've asked about what is the cost of property, investment property and owner occupied property. Okay, some question around investment property and owner occupied property is there. So now we have a basic idea. No need to deep dive or learn the entire thing. Just a quick review of the question if you do, and then come back to the case. That will help you to solve the question quickly and basically faster. Okay. So ABC is a company. They manufacture automobile parts. Currently they have a net profit of 20 lakh. Great. For this net profit is for the third quarter alone, because this question is relating to Ind AS 34 interim financial reporting. Okay. Following adjustments are made while computing net profit. These adjustments are already done. Bad debts of 1 lakh incurred during the quarter. Okay, stop there, sir. Sir, we have a simple rule. What is that simple rule? Sir, the way you prepare annual financial statements, on the same principles, interim financial statement also should be prepared. Meaning, if any expense, if you will recognize in the current year annual financial statement, means in interim financial statement also, in that quarter only that expense should be booked. Deferment is not allowed. In annual financial statements, if you can defer, in interim financial statements, also you can defer. In annual financial statements, if you cannot defer income or expense, then in interim financial statement also you cannot defer income and expenses. That's simple thumb rule. Okay. Now bad debts, do we defer while you're preparing annual financial statements? Will you defer bad debts? No. Whenever it arises that year, you book off. Yes. So now this bad debts has come in this quarter, third quarter. So can you defer it? No. Entire 1 lakh bad debts which has come in this third quarter should be accounted in third quarter itself. But what has our super duper accountant done? 50% of bad debts has been deferred. He's saying 50% I'll book this quarter, 50% I'll book next quarter. Acceptable? No. Even entire 1 lakh you have to book it in third quarter itself. But he has booked only 50,000. That means other 50,000 he has not booked. Okay. So one expense of 50,000 he has not recognized. 1 lakh of 50%, 50,000. Yes. Okay, that is one. Next, 5 lakh expenditure on account of administrative expense. Stop there, sir. If any administrative expenses arises in annual financial statements, will you defer? No. You will book it. If current year, if it comes, means in the current year only you will account. So this particular admin expense is coming in the third year. So will you defer it? No. Book it in the third quarter itself. But what is the accountant doing? This admin expense pertains to the third quarter. It's been deferred on the argument that fourth quarter will have more sales. Therefore, fourth quarter should have higher expenditure. They are saying fourth quarter is having higher expense. So, entire 5 lakh expenditure, we will defer it. We will account it in the fourth quarter. Acceptable? No. You have to account it in the third quarter itself. So, these are mistake. He is not recorded 5 lakh. Okay. So, now the requirement of the question they ask. No. So, they ask the treatment for bad debts. What should we do for bad debts? Entire 1 lakh you should recognize in the third quarter itself. But how much is recognized? Only 50,000. So, how much is not recognized? 50,000 he did not recognize, which we have to recognize. So, option A is the right answer. Check. Bad debts expense incurred during the third quarter should be recognized in the same quarter. Accordingly, 50,000 should be deducted from 20 lakh. That 50,000 they deferred it, no? So, that is not acceptable. You have to book this additional bad debts or loss in the current quarter itself. And due to bad debts, obviously your profit will reduce. So, from 20 lakh, this 50,000 profit should be reduced. That is the answer for question MCQ number 1. Second, they ask what is the correct net profit? How do you get the correct net profit? So, the net profit, anything I've written over here. The net profit they have given in the question for third quarter is 20 lakh. But they have not considered 50,000 of bad debts, which we need to reduce. They have not considered 5 lakh admin expenditure because both these expenditure they have deferred. It can't be deferred, so reduce it. If you reduce both, you will get 14 lakh 50,000. 14 lakh 50,000 is the correct net profit for the current third quarter. So D for Delhi is the right option for question number 2. So that's all. First case we have studied and 2 MCQs we are done. Next, the same case study, they have given one more para. This particular case is on Ind AS 115. ABC company, they have entered into a contract to build a power plant for the customer. One customer has approached us to build a power plant. Okay, big project. Yeah, we have got it. The entity will be responsible for overall management of the project, including services to be provided like engineering, site clearance, foundation procurement, construction of structure, piping, wiring, installation, equipment, finishing. Sir, nuclear power plant is a big project, right? You'll have to do a lot of things for that. Hire a lot of engineers, buy a lot of materials, buy a lot of machinery, right? You'll buy a lot of pipelines, etc., etc. Many things you need to buy, and many service also you need to give. So the question is, how many performance obligations are there over here? So like here, site clearance, foundation procurement, construction, wiring, installation, all these are separate performance obligation, or does this contract have only one single performance obligation? Sir, this is a single performance obligation. Why? Sir, performance obligation means what? If you see the definition of performance obligation as per Ind AS 115, performance obligation is a promise made in the contract with the customer to transfer a distinct goods or service, a series of distinct goods or service which are substantially same and have the same transfer pattern to the customer. And when can you say goods or service are distinct? You can say goods or service is distinct when the customer can benefit by using on its own, okay, either on its own or with the resources available to the customer, and the goods should not be highly interrelated, interdependent. The keyword there is highly interrelated, interdependent. Now, all this wiring service, installation service and all may look like a separate service, but all this service are given in relation to power plant. Customer wanted one activity called power plant. To construct this power plant, you have to do all other sub activities. But all these sub activities are all highly interrelated, interconnected. You can't just give installation to the customer and say we are done. No, he wants power plant. In relation to power plant, you have to give installation. So that means all these are highly interrelated, interconnected. So hence, this particular contract has only single performance obligation. That's what this was a question. How many performance obligation? Single performance obligation. In fact, same question we have done in class also. Okay, the next case study. In the year 20x1x2, ABC incurred the following expenditure in acquiring one property. Okay, consisting of 6 identical houses. So we have purchased 6 houses. Okay, and we have incurred some expenditure also with separate legal title, including the land on which it is built. Okay, the expenditure on various dates are given below. So purchase cost of the property is 1 crore 80 lakh. Can you add it? Yes. Non-refundable taxes. Can you add non-refundable taxes? Yes. Refundable taxes you cannot add. Excuse me. I hope the audio is fine. Yeah. Good. There is no lag, right? Great. Okay. So non-refundable taxes, can you add? Yes, non-refundable taxes you can add off. That's not going to be a problem. Next, legal cost relating to acquisition of property. Can you add that? Yes, these are all directly attributable costs you can add. Advertisement expenditure, opening ceremony, the day-to-day repairs and expenditure, administrative expenditures, abnormal loss, all this you will add up. No, all this will be transferred off to SPL account. In fact, same question is there in our class notes also. This is same study material or some previous year paper question this is. We have done the same, ditto same question we have done. So first requirement of the question is, in fact, so these are basically how much is the total cost? What and all can you add? Purchase cost 1 crore 80 lakh you can add. This non-refundable taxes you can add. So it became 2 crore. 2 crore plus 5 lakh is 2.5 crore or 2.05 crores. Yes, 2 crore 5 lakh rupees is the total cost of the property. Okay, now what are they saying? ABC uses 1/6. There are totally 6 houses, no? One of the 6 houses, they use it for office and accommodation of few staffs. So one office, they're using it for some office purpose and they've also let it out for staff. So accommodation given for staff is also what? Owner occupied property or PPE only. Yes, no? So this is owner occupied property itself. The 5 houses, they've rented it out. Sorry, they've rented it out means this becomes your investment property. Yes, no? So if you're using it for rental or capital appreciation purpose, the land or building, that only we call it as investment property. So the total cost of the property is 2 crore 5 lakh. In this, totally we have 6 houses. In that, one is a PPE or owner occupied property, another 5 is investment property. So 2.05 lakh or 205 lakh is the total cost of all the property. So what is the cost associated with owner occupied property? 1/6. So 2 crore 5 lakh and 1/6 if you do, you'll get 34.167 lakh. That is the cost of owner occupied property. And the balance 5/6 will be cost towards investment property. That's what they asked in the MCQ question. One, not as the cost of total entire property, which we already found, 2 crore 5 lakh. Then what is the cost of investment property, which we did? 1 crore 70 lakh. This is what we got over here. 1 crore 70 lakh 83,333. And owner occupied property ka cost is 34 lakh 16,667. That's what they have asked, sir. That's it. Okay, G. Straightforward. Correct. So first case study and its related questions we have done. Moving on to the next case study. This is also a repetitive question. In fact, we have done a number of questions like this in our regular class. But anyways, nonetheless, we'll go through. But quickly, we'll read the requirement. One, they ask basic EPS. Another one, diluted EPS. Okay. Then they ask you what is the nature of contract. Then they are asking you what is the nature of financial instrument. So 2 theory questions, 2 number questions. Okay, so this question is based on Ind AS 33 ka. Let's read this. Again, story they have given. You just need current year is ending on 31st March 20x1. Okay. Now, profit attributable to ordinary shareholders for the year 20x1 is 12 lakh rupees. So, each earnings attributable to equity shareholders. This only for our class purpose we used to call it as each. Yeah, how much is that? 12 lakh. Weighted average number of equity shares they have only given, which is 5 lakh. That means basic EPS straight away you can calculate. No, each is 12 lakh, Wayne's is 5 lakh. So 12 lakh divided by 5 lakh will give you basic EPS of 2.4. Done. Then no, average market price of one ordinary share is 20. Weighted average number of shares issued under option is 1 lakh. Exercise price of shares issued under option is 15 rupees. So some option to buy additional shares is given. Maybe to employees, maybe to others, we don't know. How many shares are given under this option? 1 lakh. And under this option, on one share, how much will the employee or others pay? 15 rupees. On one share, they will pay 15 rupees. They have an option to buy 1 lakh shares. But the average market price of the share is 20 rupees. Yes, no, this is your diluted adjustment. Here, some shares are issued for nil consideration. Yes, no, same working note we used to do in our regular class. Now, total proceeds expected is how much? Sir, all these are POS. Okay, all these are potential ordinary shares because these options will vest not today, in future, maybe after 1 year, 5 years, 10 years, we don't know. They have not told. Okay, now, so you have given some option this year. It will get vested sometime in future. Okay, all right. Now, when this options gets vested, how much money company will receive? 1 lakh shares someone else will buy by paying 15 rupees per share. So the total proceeds the company will receive is 1 lakh into 15, which is 15 lakh. Okay. Now, if you have 15 lakh rupees money with you, and if the market price of one share is 20 means, how many shares can you ideally buy? You have 15 lakh rupees with you currently, and if the price of the share is 20 rupees means, how many shares can you actually buy? With 15 lakh, and if the price of the share is 20 means, you can only buy 75,000 shares, correct? No? Yes, because 75 into 2 only, into 20 only, if you do 15 lakh, you will get, correct? So 75,000 shares only what? Ideally, number of shares you should have given under option. But you gave how many shares under option? You have issued now how many shares under option? 1 lakh. In fact, no sir, it's very simple over here. Market price is 20, you have issued at 15. So that means you have issued these options at discount. No, that impact we are trying to call out in EPS, called diluted EPS. So some shares are given at a lesser price, lesser than market price. No, that only we call it as shares issued for nil consideration. So considering the money you have received and considering the market price, only 75,000 shares should have been issued. But company issued 1 lakh shares. So in a way, on 25,000 shares, it's given at free of cost. Company has not collected any money because they've issued the shares at discount. This only we call it as number of options or number of shares issued for nil consideration. These took a minus, which is 25,000. This is your dilution adjustment. Yes, same question we have done in class also. Yes, so dilution adjustment on each is nothing. Okay, because when these options get vested later on, the shareholders will receive money. So on your dilution adjustment relating to this option on each is 0. So for DEPS purpose, each will be same. So these two addition if you do, you will get 12 lakh rupees. But have you issued any shares for nil consideration? Yes. How much is that? Just now we calculated 25,000. That's your dilution adjustment. So adding these two, how much you're going to get? 5,25,000. So this is your each for DEPS purpose and this is your Waynes. These took a division if you do. 12 lakh divided by 5,25,000, you'll get 2.29. So basic and diluted EPS, you have got 2.4 and 2.29. So B for Bengaluru and A for Alpha is the answer for question number 1 and 2. That's all. Okay, very simple, straightforward question. Correct? No, all this was there in your CA intermediate only. Yeah, same thing was we did in India. Regular class also. Okay, moving along. DEF, one company, they enter into a contract to buy 100 tons of cocoa beans at 1,000 per ton, delivery in 12 months. So we made a contract to buy some purchase of goods. We have made a contract. Okay, has purchase already been done? No. Delivery you will receive after 12 months. Okay, so you made the contract now only. Maybe you are scared that the price may increase in future. It's an inflationary environment. That's the reason you made the contract now only. Okay, to buy 100 tons and each ton ka price is 1,000 rupees that you already agreed. But delivery you will receive after 12 months. That means this is an executory contract. Yes, now we have studied Ind AS 37. Executory contract means they are those contracts in which neither party have performed their obligation, or both the parties in the or all the parties in the contract have performed their obligation to equal extent. All of them have signed here, so that obligation is fulfilled. Okay, neither party have performed their obligation means, sir, one guy has to purchase means they have obligation is what? To pay the money. Payment will be done later. What is the other party ka? Seller ka obligation to deliver the goods. Has that happened? No, that will happen after 12 months. So what sort of contract is this? Executory contract. We have studied this in Ind AS 37. Yes, no? Okay. The contract cannot be settled net in cash and is entered for delivery of cocoa beans. So you can't do it on net basis. If you remember, derivative contracts, no, usually we settle it on net basis. Not a mandatory, but usually derivative contracts are settled on net basis. So are we settling this on net basis? No. So when you enter into contract and say you will settle on net basis, it essentially means we are not interested to purchase cocoa beans. We are only interested to we are betting on the price game. Okay, so that's what we mean by net basis. When you say net basis, when you enter into contract on a net basis, one guy will gain, other guy will loss. So those are derivative contracts. Here settlement is not done on net basis. So we actually want to purchase this cocoa beans. So what sort of a contract is this? This is a non-derivative contract, and these are executory in nature. That's what you need to write over here. That's what is a requirement of the question. There's an executory contract as well as it is a non-derivative contract. That's what. Okay, sir, a theory question. In fact, same question we had done in Ind AS 109 ka. Okay, one of the question had one of the part like this, which we had written. This we used to write it as own use executory contract. For own use exemption, Ind AS 109 is not applicable. We had written like that, a word. If you flip through the notes, you will get it. That question ka one part, they have taken it and made an MCQ here. Okay, DEF invest in compulsory convertible preference shares of CCPS. So one company has invested. Okay, so if you invest in one company ka preference shares, so it's a financial asset. No, for DEF it will be a financial asset. They've issued in subsidiary ka preference shares. They've invested. Okay, and value and all they've given at 1,000 rupees each. Face value is 10, premium is 990. That's all right. Under the terms of the instrument, each CCPS is compulsorily convertible into one equity share. So this is compulsory convertible equity preference shares. Okay, so one preference shares, one equity shares will be issued on conversion that they have directly agreed. And when will the conversion happen? At the end of 5th year. Such CCPS carry a dividend of 12%. It's a preference shares, no? So preference shares will have some dividend rate. That dividend rate is 12%. Payable only when the dividend is declared at the discretion of B Limited. So usually, sir, on preference shares, you have to give the dividend. The company which is issuing preference shares, they have to pay the dividend because usually preference shares are cumulative in nature. Okay, even if current year, if you suffer a loss, Next year when you make a profit, next year ka dividend as well as arrears of dividend you need to clear. But here they told nature of preference shares is such that the dividend declaration is at the discretion of B Limited. Meaning B Limited has issued preference shares over here. No? If they want, they will give preference dividend ante. Otherwise, they will not give, it seems. Okay, so that means what, sir? We know that now there is no preference shares category. Preference shares is either classified as financial liability or equity for the company issuing it. Who is issued? B Limited. So there is no obligation to pay principal because it is getting converted into equity shares. And how many equity shares is also fixed. So fixed to fixed test is passed. And dividend also is what? Discretionary. If the company wants, they can pay. If they choose not to pay also, that is also fine. So dividend ka payment obligation is also not there. Principal obligation, dividend obligation, both are not there. That means for B Limited, this should be what, sir? Equity. For the other company who has made an investment, it's a financial asset because we have a contractual right to receive cash. Yes, no? Correct, people? Okay. Or if you have a contractual right to receive equity, instruments of another entity are also financial assets only. Yes. So for the DEF, it is financial asset. Now here in this question, there is a small typo. Okay. They've asked the nature of financial instrument. They've selected the answer as equity. Okay. But I think there is a small typo here because if you just check the case study is relating to DEF. So for DEF is an investor, sir. For investor, it is not equity or financial liability. It's a financial asset. So they should have given the question here as and answer the question from B Limited perspective. That the typo in this MCQ question. I should have written that analyze the nature of financial instrument from B Limited perspective. From B Limited perspective, yes, it is equity. Because from DEF perspective, it is a financial asset. Okay. So a small typo in the question. Okay. Let's ignore the mother body there a little bit. Maybe they'll correct it later on. Okay, sir. Yes. So this question is done for. Moving on to the next, case number 3. The same question we have studied in Ind AS 103, question number 10, but nonetheless, it's an MCQ, so quickly I shall cover it off. Just 1 second. Yeah, moving along. PQR is required to adopt Ind AS from 1st April 20x1. Okay. Sir, again, let's lead off the question once. One, they've asked the total consideration transferred by PQR to XYZ. Maybe there's some business combination over here. That's the reason they've asked the total consideration, meaning PC they're asking. Okay, goodwill they're asking on business combination. Great. What is the gain? It should be total gain. Again, a small typo here. Held on the previously held interest in XYZ, recognized in P&L. Fine. They've asked the transition date and they've asked the comparative financial statement. Sir, for these two, I don't even have to read the question. Sir, you are applying Ind AS from 1st April 20x1. So current year is 1st April 20x1 and ending on 31st March 20x2. Correct? So what will be? Whenever you prepare current year ka Ind AS financial statement, even previous year ka financial statement, comparative financial statement also you need to prepare as per Ind AS. So previous year comparatives you have to give on 1st April 20x0 to 31st March 20x1. Correct? No? So both the things has to be prepared as per Ind AS only. Correct? So we have studied. So that means effectively what date are you moving to Ind AS? 1st April 20x0. This only we call it as a date of transition. Yes, no? The beginning of the previous period for which comparative financial statements you give, that only we call it as a date of transition, DOT date. Yes, here DOT date is 1st April 20x0. That's what they've asked. What is the transition date? 1st April 20x0. And for what period comparative financial statement you will give? X0, X1. So that is your option, D for Delhi. So without even reading the case study, we have answered off the 2 MCQ question because pretty straightforward. That's the reason we always say first read the requirement, because sometimes they'll give a lot of stories. But the requirement will be very, very straightforward. You don't need that story at all. Just 1 or 2 lines if you read, you can answer off MCQ question. Okay, moving along. You also have some business combination related part. So we'll read the case study nonetheless over here. So Ind AS you adopted on 1st April 20x1 with comparatives for 1 year 20x0x1. That also they only given. Okay. So on 1st April 20x1, PQR acquired 30%. On 1st April 20x1, mind you, they acquired 30%. With 30% do you get control? No, with 30% you only get significant influence. Okay, maybe some extra shares you acquired a little later on. Okay, probably this is a step acquisition scenario. PQR acquired 30% of the voting rights in XYZ for 8,000 crores. Great. PQR accounts its investment in XYZ using equity method. That's what Ind AS 28 says. No, investment in associates should be accounted using equity method. A simple way to remember it is match investment ka value with associate ka performance. If associate makes any profit, investment balance will increase. If associate reports any OCI item, still investment balance increases. If associate declares or pays dividend, investment value reduces. All this we have done. Okay. At 31st March 20x2, P Limited recognized its share of net asset changes using equity method as follows. Now the associate company, they have not given profit, they have not given associate profit, they have given associate company ka share of profit. So this is investor ka share only they have given. So our share in associate profit is how much? 700. So due to this, investment balance will increase. So it was 8,000. It will increase by 700. Okay. Then associate made some OCI also, exchange difference. These are reclassifiable OCIs. Okay. Meaning when you lose significant influence from OCI reclassifiable, you have to transfer from OCI to SPL account, P&L account, because these are reclassifiable OCI items. All this we have done it in regular class. Yes. So that is 100. So due to this also investment balance will increase. We have some revaluation reserve OCI. Revaluation reserve OCI is non-reclassifiable or non-recyclable OCIs. So this, when you lose significant influence, directly you have to transfer not to SPL but to retained earnings. Okay, when you lose significant influence. And our share of such is 50. So due to this, again investment balance will increase. From 8,000, it will increase by all this. So hence the balance will become 8850. That's what they've done over here. Adding all this with 8,000, they got 8850. Okay, this is associate ka drama. Okay, now they ask business combination question. No? So all this happened in 1st April 20x1, meaning x1 x2 wala year. Now next year, 1st April 20x2, next year ka first day, PQR acquired remaining 70%. We had 30%, we purchased off another 70%. That means we have total 100% now. We got control. So this is your what, sir? On 1st April 20x2 becomes your DOC, date of control wala date. Okay, okay. The following additional information is given, and we purchased the 70% stake by paying 25,000 crores. So that's a PC given in the form of cash. Some extra information they've given. Fair value of 30% interest is 9,000. Fair value of XYZ subsidiary ka net asset is 30,000. Now we know this. Okay, so now what has happened over here? We gained control, but at the same time we lost significant influence. Okay, so when you lose significant influence, what and all you have to do? One, whatever is the OCI R, it has to be transferred to SPL. How much? 100. Whatever is OCI NR, you have to transfer it to retained earnings. How much? 50. Like that. Yes. And what one more, sir? Sir, you have studied Ind AS 103, right? How do you get goodwill or business combination? You take one PC given in the form of cash and you take fair value of existing investment. If you remember, on the date of control, if you have any investment already, you have to take the fair value of that existing investment. Do you have existing investment? Yes, we had 30%. What is the fair value of that 30% investment? 9,000. But hang on, are we showing 9,000 in our books? No. The fair value of 30% interest is 9,000, but the carrying amount as per equity method is 8850. So from 8850, you have to increase it to 9,000. Correct? Now, so how much is the gain? 150 is a gain. So that is nothing but 9,000 minus 8850, which is 150. So totally, how much gain will go off to SPL? This is also, you have lost significant influence, no? So whenever you lose significant influence, you will get some gain or loss like this. Okay, that gain or loss should be transferred off to SPL. So these two will go off to SPL. How much is that? 250. This 50 will go off to, since it's OCI NR, it will be directly be transferred to retained earnings. Correct, sir? That's all. Now they ask the total consideration given. Okay, maybe first we'll do off the business combination ka working, then we'll read the requirement. Okay, now we have what control. So on the date of control, we calculate goodwill. How do you get goodwill? First you take PC, you give cash. How much? For 70% you pay 25,000, this is given. And then if you have any existing investment, take the fair value of existing investment on the date of control. Is it given? Yes, given to be 9,000. So add it. Okay, since we have acquired 100%, there is no NCI over here. So NCI portion is 0. Just for the format sake I've written. Then reduce net assets on the date of control. They have only given fair value of net assets on the date of control for associate company is 1 minute. Is 30,000 rupees. Here it's given. Yes. So reduce that. So if you get a positive number, goodwill, negative number, bargain purchase gain. Yes, 34 minus 30 gives you goodwill of 4,000 rupees. Okay, now based on this, we can answer the MCQ question. First, what is the fair value of total consideration transferred by PQR? PQR is the whole parent company, XYZ is subsidiary. What does the total consideration means? They're asking you the PC. What is the total PC? Now we gave 25,000 plus the fair value of existing investment 9,000. So this two addition will become your PC. How much is that? 34,000 rupees. Okay. Same ditto question. What is the goodwill on business combination? We already calculated, which is 4,000 rupees. So that is the right option here. Okay. Then what is the gain on previously held interest? Sir, this word now is a typo over here. If they just ask what is the gain on previously held interest? Okay. Now when you lose significant influence, the carrying amount of the investment as per equity method is 8850. But for Ind AS 103 purpose goodwill accounting, we take fair value. right? And what is the fair value of that existing investment? 9,000. So from 8850, you need to bring it to 9,000. So there is a gain of how much? 150, correct? No. So this is the gain relating to previous held interest. So there's a typo. They should have given that question as what is the total gain? Because there are two gains over here. No? We have OCI R also, which will be transferred to SPL. So what is the gain recognized in SPL means this one from 8850 we have to take the investment value to be 9,000. Hence one gain is 150. Another OCI reclassifiable item we have to transfer it to SPL, which is 100. So total gains becomes 250. So they've selected 250 as the option in the answer. So that means there is a typo in this particular question. They should have written it as total gain or not just gain. Because if you just read the word what is the gain on previously held interest, the gain on previously held interest is only this much, which is 150. So again, this is I think small typo from ICAI end over here. Okay, they're trying to ask the total gain over here. Okay, if same question comes in your attempt, if by chance if they don't write total gain, write the same answer. Okay, till it's corrected we have to follow what is done in ICAI. Okay, so if they ask the word, calculate all the gain, this gain also and OCI R gain also, you add up and then transfer it to SPL. Better to be on the safer side. Okay. What is the date of transition? I think we already selected this, 1st April 2080, and this comparative financial statement also we have done. So with this, if you just check all the MCQ question, not even a single MCQ question also in reality is new. Everything ditto only. From our regular concept questions and notes only, nothing new as such. Yes, people, but still, MCQs we have covered. As I said, descriptive is all repetitive. No point in doing the same thing again and again and wasting your time and my time. So I think with this, we'll call it off. Hopefully this session was helpful to you. Take care. See you. Bye-bye.